Some people make life-changing money by investing in stocks no one's ever heard of. But how do you find these stocks before they explode higher and become household names? You're not going to find out about these stocks from influencers or most media outlets. They're mostly focused on what gets views. And that's usually popular stuff like Tesla, Nvidia, and Apple. The same names over and over and over again. Whereas the best stock picks for the future, well, they are not that popular yet. They're kind of hidden and they don't generate views. That's why I'm doing something a little bit different today. Even if it means fewer people see this video, because I'm not just doing what the algorithm wants to do to show you well-known stocks. In this video, I'll show you a proven system that can help you progress through the obvious picks so you can locate lesser-known stocks with truly exciting upside potential. And by the way, let me introduce myself. I'm Steve Reitmeister. I was editor-in-chief of Zacks.com for over a decade, and I'm currently a partner at WallStreetZen.com. After 40-plus years of investing, I learned a lot about locating high-quality stocks, and I'm happy to share some of my insights with you today. If you like the sound of that, go ahead and hit that like button down below. Thanks so much. Okay, before I get going, let me get on my soapbox a little bit here and share with you what I see as a huge problem with the majority of the stock content out there. Creators cover whatever generates the most engagement. Hot sectors everyone's talking about, dramatic market moves, controversial takes, unpopular stocks. That's what the algorithm rewards. Gladly for you, I'm not a slave to the algorithm. I'm looking at the stuff that isn't designed solely to generate views. I'm not talking about Tesla, which is obscenely overpriced. Instead, I'm looking at stocks like a well-run industrial distributor with robust earnings growth that nobody's heard of. I truly love finding companies doing one thing exceptionally well in sometimes unsexy industries. That is often the ticket to outsized returns. Remember that popular content and profitable investments often have zero overlap. When a stock becomes interesting enough to make viral content, the easy money's already been made, meaning you are late to the party. This is the fundamental disconnect. Content creators optimize for maximum reach, whereas you should optimize for maximum returns. These aren't the same thing. For example, Peter Lynch, legendary investor from Fidelity, he didn't find winners by watching what everyone else was talking about. For example, he found Dunkin' Donuts by noticing his local store was always packed. He paid attention to what was actually working in the real world before it became headline news. That's the edge individual investors have. You can act on information that wouldn't make good content, but indeed makes for great investments. So, how do you actually find these stocks before they become popular? First method is to look for companies quietly gaining market share in industries most people ignore. Here's the key insight. When a company is generally winning in the market, taking share from its competitors, expanding margins, growing faster than the industry, the data tells a story before the hype begins. You don't need insider information. You just need to look at the right metrics in the right places. The market eventually catches on, but there's often a window of months or even years where a well-run company flies under the radar. The problem most investors have is that they are looking in all the wrong places. A prime example is watching CNBC for the hot stock of the day instead of screening for companies with consistent growth and financial metrics that compound investor returns over time. Let me show you what this looks like in practice. I'm going to use a stock today, Alliant, the symbol of ALNT, as an example. This is a precision motion control company. They make motors, servo systems, and encoders that go into industrial equipment, medical devices, and automation systems. Not sexy, not going viral, doesn't have the AI oomph that Nvidia or Palantir have going for them. But here's why Alliant caught my attention. Revenue and earnings growth has been remarkably consistent. Add in improving profit margin and you get 50% earnings growth over the last 3 years. That's the signal you're looking for. When a company is growing revenue and expanding margins simultaneously, they're winning in the market. They have pricing power. They're operating more efficiently than their competitors. Alliant has been making strategic acquisitions, expanding into robotics, semiconductors, and high-growth segments where precision motor control is critical. And the customer base is diversified across medical, aerospace, industrial automation. Multiple end markets, all growing, helps to reduce the concentration risk. Now, here's where it gets interesting from a market positioning standpoint. They're ranked as the #1 stock in the electronic components industry. They're not a niche player. They're the leader in a space that most retail investors have never heard of. So why does this matter? Because this isn't a company you'd find by watching financial media. There are no viral tweets about precision motion control system, no YouTube YouTube thumbnails screaming about servo motors, right? But if you're systematically screening for companies with consistent growth, expanding margins, leadership positions in their industry, and strong fundamentals, this is exactly the kind of stock that appears. Find companies quietly dominating market nobody's paying attention to. Look for a combination of consistent growth, improving profitability, and industry leadership. The market eventually figures it out, but you want to own it before that takes place. To stay ahead of the curve, you just need to look for the right financial patterns in the right places. Please be sure to watch the video to the end, as I will share exactly how to find these kind of stocks more consistently in the future. The thing that I call the influencer problem isn't limited to the world of social media. Wall Street has the same problem as YouTube. Everyone's trying to impress each other. Yes, I recognize I'm saying this on YouTube, but nobody wants to pitch the waste management company. Nobody is winning awards for funeral home stocks. These don't make exciting presentations, but it's exactly why they can be phenomenal investments. Peter Lynch, who I mentioned earlier, made a fortune on Service Corporation International in the unappealing funeral services industry. He specifically looked for low-growth industries because there was so little competition. A 1% growth industry like funeral services doesn't attract floods of venture capital. The dominant player can compound profits for decades without someone disrupting them every few months like many other industries. I'm going to hit you with another example here. Commercial Metals Company with the symbol of CMC. They operate in an industry that sounds about as exciting as watching paint dry, right? We're talking about steel manufacturing, scrap metal recycling, and rebar fabrication. Okay, no AI angle, no crypto integration, no celebrity founder, just a boring 110-year-old company turning scrap metal into construction materials. But look at what that boredom translates into. They're one of the two largest rebar producers in the United States. Every highway, bridge, building, and a piece of infrastructure being built right now likely includes rebar. So there's a good chance CMC's rebar is reinforcing the concrete. It's completely unglamorous, and yet it's absolutely necessary. Here's why the business model works. They collect scrap metal, over 17 billion pounds annually, process it in their own recycling facilities, melt it down in electric arc furnace mini mills, and fabricate it into rebar and other steel products. Vertically integrated from scrap collection to finished product. The vertical integration creates a massive competitive advantage. When steel prices spike, they're somewhat insulated because they control their raw material supply through recycling. When scrap prices are low, their input costs drop while finished product prices stay stable. They capture margin on both ends. The company's been around since 1915, having survived many recessions, and yet over time just keeps quietly compounding shareholder value. Looking at just the past 5 years, the compound annual growth rate for revenue has been about 8%. That's well ahead of the industry average, closer to 6%. Now, that's not explosive, but it's consistent. And like our previous example, it's all about expanding operating margins. This has analysts predicting 35% earnings growth year over year. Yet what really stands out is the value story. This shows up loud and clear in their price to earnings growth ratio, right? The PEG ratio, which is just 0.69. As you probably know, anything under 1 is very, very attractive. Okay, now listen. This is the kind of stock that will never make anyone jealous at a cocktail party. No one's bragging about their steel recycle, but it's exactly the type of company that quietly compounds wealth over years and decades. The pattern here: find companies doing necessary but unglamorous work where they have structural competitive advantage in industries that don't attract a lot of attention. These companies often trade at attractive valuations specifically because they're boring, and yet they produce predictable cash flows and there's little disruption risk from outsiders. Screen for companies in unsexy industries, waste management, building materials, industrial distribution, regional banks, and the like. Again, keep watching till the end as I share some of the resources we built on WallStreetZen.com to make this type of stock screening a much easier task. Okay, now consider looking for companies with minimal Wall Street analyst coverage. If fewer than 5 analysts cover a stock, then information inefficiencies exist. This often means the market hasn't fully priced in what's happening because there aren't enough investors tuned in. Be willing to own companies that won't impress anyone. Pride doesn't pay bills. Boring companies with consistent cash flow do. Most of what works over time is boring and methodical, exactly opposite of what the algorithm rewards. That's why you need to know this. Okay, if you're getting value from this approach, finding real investing opportunities instead of chasing headlines, hit subscribe and the notification bell so you'll know when my next video drops. Okay, now let me tell you how to systematize this entire approach, because most contrarian approaches like we talked about today today is a very manual, time-consuming endeavor. Gladly, we have made some filters to more quickly separate what actually works and what just sounds good. Okay, remember that the most successful investors use some form of systematic analysis. The key here is to have objective criteria that remove emotion from the decisions. Think about how this works in practice. You have a thesis. Maybe you think industrial automation is growing or infrastructure spending will drive demand for building materials. That's your idea generation. Now, what do you do next? You need to verify which companies in those spaces actually had the fundamentals to capitalize on the trend. Are they growing revenue faster than competitors? Are margins expanding or contracting? Is the balance sheet strong enough to weather a downturn? Is the valuation reasonable, or have you already missed the move? Peter Lynch had a simple framework. The PEG ratio under 1, preferably closer to 0.5, debt under 50% of equity, consistent earnings growth, no wild swings, right? Simple metrics systematically applied that kept him out of the value traps and away from the momentum stocks before they peaked and cratered. At WallStreetZen.com, we've built our own quantitative system called the Zen Rating. It looks at 115 different factors and metrics for every stock, then distills all that down into a simple, intuitive, and proven framework. What Lynch did manually, we can do at scale across thousands of stocks simultaneously thanks to the work of the Zen Ratings, where we are looking at 26 metrics for financial health, 22 measures for growth, 22 metrics for value, and then we just keep rolling into momentum and sentiment and safety, even our own proprietary AI factor trained on a neural network designed to spot formers. The big picture of those 115 factors is boiled down into a single metric. That's the Zen Rating. We use an intuitive letter grade system going from A through F. Indeed, our A-rated stocks are the best of the best, given that they rank in the top 5% based on those 115 factors. Here's why quantitative systems matter. They keep you honest. It helps you power beyond the hype. You might love a company's story. You might be impressed by their management team or excited about their market. Unfortunately, that isn't enough. If the numbers say they're burning cash, growing slower than the industry, or trading at 50 times earnings, you don't invest. The system overrides your enthusiasm when reality doesn't support the odds of success. Start with A-rated companies in a systemic stream. Stocks scoring well across all fundamental facts. Then figure out what they do and whether their competitive advantages make sense to you. Actually, you can do it both ways. Either start with observation and validate with numbers, or start with numbers and validate with observation. Both examples I show, Alliant and Commercial Metals, they weren't random picks. Both were A-rated stocks. In fact, they score in the top 1% of the Zen Rating system. Plus, they have clear competitive advantages you can understand. Alliant, the industry leader in precision components, CMCs, vertical integration, and steel. The quantitative screen identified them. The business quality validated them, right? This is the synthesis. Look for growing market share in places others ignore. Be willing to own boring businesses in unsexy industry. Filter everything through a systemic quantitative analysis to confirm the fundamentals support your growth thesis. Let me give you the actual workflow you can start using today. And that's step number 1, define your hunting ground. You're not looking everywhere anymore. You're now looking specific places others avoid. Unsexy industries with modest growth rates, companies with minimal analyst coverage, markets where there's consolidation happening, but nobody's paying any attention. Try and build a watch list of 20 to 30 of these tickers that match these criteria. Now, step number 2, run systemic screens. Revenue growth consistent over multiple quarters, margins expanding, contracting, a high return on equity ratio, top industries with a Zen industry rank of A or B. These are your quantitative filters. Any company that doesn't pass gets removed immediately. Step number 3, for companies that pass the screen, understand the business model. Why are they winning? What's their competitive advantages? Is it durable or is it temporary? Can you explain their business in 2 sentences? If you can't, you don't really understand it well enough to own the stock. Okay, step number 4, check the valuation. A great company and an insane price is still a bad investment. Look at the PEG ratio. Look at the price to free cash flow. Look at the enterprise value to EBITDA. You want reasonable valuations, not unusual bargains, because sometimes super cheap stocks often have hidden problems. The easiest way to find those is by filtering for stocks with an A rating for value. Step number 5, size positions appropriately and know your investment thesis. If shares drop 10 to 20%, you need to ask, did the fundamentals change or just the price? If fundamentals are still intact, then a price drop is actually a great buying opportunity. If the thesis changed for the worse, like a bad earnings report, then you sell immediately. The systemic approach keeps you from getting caught in hype circles or panic selling. You're following a process that identifies quality companies before they become popular, validates them through multiple lenses, and gives you conviction to hold when others are selling emotionally. I use the same system to zero in on 3 stocks that I think are most likely to double in 2026. So if you want to check out these 3 exciting stocks, I'll put a link to our free report in the description, or you can scan the QR code. It all boils down to this. The hardest part isn't the process. It's the discipline to follow it when everything else around you is screaming to do something else. That's why systemic investment approach tends to beat the discretionary approach over time. The stocks that make you serious money are rarely the ones dominating your newsfeed. By the time something's popular enough to generate millions of page views, the easy money is gone. You're not buying at 15, you're probably buying at 75 after the story is fully priced in. The real edge here comes from the systemic work in places others won't look. Screening for companies growing consistently in boring industries. Find businesses with structural advantages nobody's talking about. Filter everything through quantitative analysis to confirm the fundamentals are real and good. This isn't about getting rich overnight with a hot tip. That's a mirage. It's about building a repeatable process that consistently identifies quality before the rest of the crowd jumps in. Sometimes that means holding stocks no one else cares about for years while fundamentals compound quietly. That's not a bug, it's a feature. You're not investing to impress people, you're investing to build wealth. The examples we cover, alien precision components and commercial metals and steel recycling, they're not going to trend on Twitter. They won't get a million page views, and that's the entire point. If you want to find stocks everyone will be talking about 6 months from now, then we need to find them today when they fly under the radar. Now, do me a favor and leave a comment down below. I'm interested to find out your favorite metrics for evaluating stocks and why. Now, let me know if you already have a framework for analysis in place, or is it still a work in progress? Now, if you want to build on these concepts with a specific tutorial on how to spot overvalued stocks, be sure to check out this video.